Why you should buy stock in a company when a CEO starts buying. Next time you see an executive invest in their own company, it might pay to follow suit. One recent tip that has been successful is to pay attention to insider trading. If executives and directors of public companies are buying or selling shares, then investors should do the same because insider trading activity is a marker for sentiment in the overall market. Research shows that insider trading activity is a valuable barometer of broad shift in market and sector sentiment. So, if you want to know why you should do the same when a CEO buys shares, then this video is for you. For today's video, exclusive for our Fortune Fastlane members, we will be talking about why you should buy stock in a company when a CEO starts buying. So without further ado, let's get into the video. Last week, United Continental Holdings announced that CEO Oscar Munoz had bought $1 million worth of the company's stock. Similarly, in February, JP Morgan Chase CEO Jamie Dimon bought $26 million worth of his company's shares, and he has seen a 20% return since the buy. An analysis of this data reveals that a regular investor could actually make money by following the stock purchases made by CEOs. CEOs often buy stocks when they can, so there's a stop average after most of these purchases. For these purchases, there's usually another jump in the stock, but it's not always the same. In addition to those 7-digit purchases, broadening search criteria find a similar pattern following purchases of $250,000 or more. There were more than 800 instances of this since 2003. Since then, there have been over 200 different examples of CEOs who bought their own company stock for at least $1 million. The data come from filings with the Securities and Exchange Commission listed at openinsider.com. Filtering out some penny stocks and other aberrational purchases, what was left showed meaningful jumps. The good news is that in 6 months, the initial capital will be paid off and then there will only be smaller payments coming in. The majority of the money comes from the first week, so it's a quick way to make some money. There is on average more money made in the first week than in any later week. Same story, CEOs and investors are probably seeing the future of their companies, and this trend continues for a short period of time. Except, they may know more about the company than others do and may buy when the stock is undervalued so that it goes up later on. With a specific subset of the information, a research tool can give you strong returns. The researchers found that when CEOs bought shares, they had higher earnings, but only examined CEOs who owned at least 5% of the company. These were experienced, knowledgeable CEOs. Many of them were company founders. Researchers found these companies performed 5.7% better annually compared with companies with similar risk profiles. In the real world, this type of strategy is hard to replicate because you would have to pay a commission fee on every single one of these companies. Though it's hard to tell by just looking at this example, big CEOs' buys might lead to better returns in the near future. When outsiders are considering trading, they need to keep in mind that the timing is crucial. They need to consider trade tensions, the factors that dictate when a trade should be made, and the factors that conceal the motivation behind making a trade. A market trend analysis shows that insider information is the best predictor of an upcoming shift in sentiment. The independent research firm Market Profile Theorem found that insider trading trends signal upcoming changes in market sentiment. MPT analysts employ the Brooks ratio, which counts the amount of insider sales of a company over the number of insider trades, buy and sell actions. If insiders are selling more than they are buying shares or have been buying or selling less overall, then it's a good sign that there will be an increase in stock prices. Professionals like university professors offers insight on insiders trading and hedging techniques. They often find that insiders are legally earning a profit off their trades because they get stock prices to rise more after net purchases than when they sell shares. The overall portfolio is gaining a stronger return than the market. Investors are selling off financial stocks at lower prices because they're afraid of a recession. The hardest hit sector is newer fintech stocks that have come onto the public markets within the past 5 years. Financial stocks might come back up later. Newly established fintechs lack a track record that many investors find trustworthy. Investors are skeptical about their underwriting process because they cannot analyze the quality of these companies unless they have had some time to build up their trustworthiness. However, new fintechs with innovative technology and exciting business models still exist. Fintechs that are on the prime end of the credit spectrum are becoming more popular, contrary to popular belief. SoFi is one of those stocks, and both its CEO and one director have been buying lots of stock over the past month on the open market. With the stock down 62.5% year to date and 80% from its all-time highs, could this mark a bottom for SoFi? Anthony Noto, the CEO of SoFi, began to aggressively increase his stake in the company. He made significant trades with over $2 million spent on shares, buying more and more shares as they went low. The board member Harvey Schwartz bought just under $400,000 worth of stock in the company. This is a 24.1% increase to his stake, and he primarily buys on that day. Insider buying is a sign that the CEO has confidence in the company and can be seen as an indication of great prospects. Insider buys are also significant in size, even for a CEO. Meanwhile, CEOs can sometimes have a blind spot about specifically the macroeconomic picture and still be wrong too. For instance, many technology software CEOs made large insider buys back, only to see unfortunate large declines in their stocks since that time. To evaluate fintech stocks, investors need to know the segment it's targeting. Fortunately, SoFi targets a secure segment of the market. SoFi's goal was to become a student loan provider and refinancer, and so its primary customers are highly educated individuals in promising fields. Then, the company received a bank charter to allow it to collect low-cost deposits and reduce regulatory costs. SoFi student loans customers typically have an income of $160,000 with a FICO score of 746. This increases to $170,000 with an average FICO score of 775. Significantly fewer students are defaulting on their loans as they tend to be highly confident individuals under the age of 30. Provided the economy doesn't go into a recession, the company should be able to make it to the other side and survive. Typically, SoFi customers base is considered by industry experts as prime, although SoFi is looking more and more like a bank after receiving its charter. Unlike most mature banks, it has seen substantial growth in the last quarter. The company experienced an increase of 49% revenue on an adjusted basis, with adjusted EBITDA just above break-even in $8.7 million. On a GAAP basis, net losses decreased from $177 million to $110 million. However, they are still negative. Still, SoFi's company saw a steady uptick in membership with their third highest quarter of customer acquisition, resulting in more members using more products. While the company is still losing money, the lending and technology segments are all contributing positively. SoFi's fast-growing financial product segments operates at a contribution loss. Apparently, there will be a lot of investment in order to generate revenue in the financial product segment. These products include checking and savings account, credit cards, and an investing brokerage. The financial product segment has grown 264% off a small base with only 74% cost increase. This new product should improve as it scales. SoFi is growing its deposits significantly in response to the bank charter it was granted that allowed it to offer a higher interest rate of 1.25%. It totaled $1.2 billion at the end of the first quarter, grew to $1.5 billion as of early May, and is growing about $100 million per week. With the bank now live, SoFi may experience rapid growth through this year because of deposits and new customers. Customer acquisition is one of SoFi's strongest points, and with the majority of money coming from lending, it has to make sure that it lends well even as the macroeconomic picture remains cloudy. One would not want to see a bank that is still losing money ramping up its underwriting in an economic downturn. However, there are few things to consider. 1. It's not certain we will have a recession. 2. SoFi's borrower base has high incomes and FICO scores which can handle an economic downturn given the 2 points. Third, the stock has gotten quite cheap by some metrics. It currently trades around a $5.5 billion market cap, just about at book value. SoFi is growing fast with a top line near 50%, but selling below book value. The company, though, is smaller and they have more stock compensation and such, so investors are unsure of how profitably the company will grow. SoFi is a company that relies on the belief in its business model, predicated on acquiring well-off graduate students and then cross-selling them more products over the long term. It also requires you buy into Anthony Noto, CEO of SoFi, and his team's ability to underwrite prudently. Noto and members of his team believe in the opportunity and put their own investments towards that. However, there's a certain risk involved with investing in these type of stocks due to the uncertainty of profits being made. It could work out well for SoFi if they use these next few years as an opportunity for innovation and adequately diversify their investments. Their stock is a high-risk, high-reward investment, but don't invest too much if it's with the CEO. Even he has strong faith in his investments, there's no guarantee of future success. When insider trading surges, the market seems to switch directions. However, investors have to hold off on reading anything into any insider purchase they see. Individual purchases shouldn't be seen as signals that it's time to sell what they have. Investors can sometimes glean an indication of what to do for the day by examining insider buys or sells, but you can't depend on the sort of information to make good decisions. Some companies require newly appointed executives and directors to pay for shares for their own finances, which is a poor indicator for outside investors. Other companies encourage ownership by providing loans to executives for half of the initial price. The company's transactions are steps to align the interests of management and shareholders. These transactions will not provide good reasons for outsiders to buy stock. Sometimes, insiders will announce a stock buy to get attention from Wall Street, but they haven't always followed through on their announcements. For example, the founder of dot-com startup Healtheon, Jim Clark, once announced that he was intending to buy up to $100 million worth of shares for his company, but he wound up only purchasing about half that amount. Heavily investing in Healtheon led to a decline in stock, and those who followed the trend got burned when Healtheon merged with WebMD. This then became part of KKR and Company, which eventually bought WebMD. Insiders sell their company stock for a variety of reasons. Company insiders may sell their stock to either diversify their holdings or distribute it among investors. Insiders sometimes need to liquidate stocks to pay for expenses such as divorce settlements. In some cases, executives may make bad decisions when they are evaluating their company. They may recommend buying as share prices drop rather than selling. It's not always the insiders that know what is going on with their companies. In many instances, it's a matter of luck or a gamble, if you will. There you have our Fortune Fastlane video for today. Don't forget to subscribe to our channel, click the notification bell, and like this video. If you think that we have delivered value, please share this video with one person. Just one share is enough for you to show your appreciation for the commitment and hard work we all put together in creating this video that teaches and helps you on your mission of building your own fortune. And you don't know that one share could go a long way. And keep in mind that no matter how many times you're going to watch this video, you won't see any results unless you take action. Goodbye and see you at the next one.